In late January, early February of 2018, we saw some sharp computer-based selling that knocked down the stock market quite viciously in a few days to the point where trading was impossible, virtually frozen. Buy and sell prices were changing by the second. I thought it would be fun to go over several past computer panics where computer fear-based trading has taken over the market and what it looked like and what happened. Give us some perspective for what's coming. So here in 2018, we started off the year with a continuation of the Trump bump, more than a bump, it was a rally since his election, up until worries hit in January that the tech sector was going to report some decreased revenues and earnings. And as prices began to fall, computer systems designed to limit the losses in certain portfolios kicked in. But the way they limit losses is they all jump in and try to sell at the same time. And it did what it always does. It knocked prices down and jarred the psychology of the market, and we're still living with that. It's a computer-based crash. We've had them before. Let's take a look at some of them. The most famous had to be Black Monday, October 19th, 1987. The market had been flat to weak for a few weeks. And then as it fell that Monday morning, the computer portfolio insurance programs that had been marketed to a lot of Wall Street firms kicked in. And the way they insured portfolios is at certain algorithm predetermined trigger points, they attempted to sell entire portfolios. The trouble is these were written by guys who'd all gone to school together, so they all had the same program, and they all tried to sell in the same 5 seconds. And at that point, the market just froze and crashed really viciously that day and the next few days. The famous Black Monday, when markets weren't frozen, they were falling. I think it's still it may be point-wise, I think it's the greatest one-day drop in stock market history, maybe percentage-wise. Of course, experts didn't see it coming, which leads me to the great story of Wall Street Week and my hero and friend and mentor, Marty Zweig. The specialists, the analysts on Wall Street Week had largely spent the previous week saying, well, the market's flat to weak, but nothing to worry about. Then Friday evening, the Friday before the Monday crash, Marty Zweig, a panelist on Wall Street Week, looked up and said, well, Lou, I'm worried about a crash. And it made Marty a legend, as well it should. He was a brilliant statistical analyst with a just awesome instinct for the market. Probably always worried about the market declining, but that was his job. Fabulous moment. Another fabulous moment was the Nobel Prize economist crash of 1998. So here, a well-known firm by the name of Long-Term Capital Management had hired Nobel Prize winners to write programs to trade markets using what are called derivatives. That is, instruments designed to mammothly increase the leverage beyond anything you can get from a simple margin position. And they made money for a few years until August of 1998, when cracks in the Russian and Asian currency and bond markets, something that was called the Asian flu back then, broke the computer system, because they they were outside the parameters that long-term capital had designed. Long-term capital crashed, and so did the markets. In a few days, the Dow lost 21%. Now, boy, I remember those days. I'd just gotten married, and I had all these tech stocks waiting for year 2000. And a lot of them were tied to that Asian economy that got whacked. So it was a terrible few weeks, but then, thank goodness, the market recovered, as you know, and ended up with its year 2000 rally. Long-term capital was so big, with so much leverage, that the Federal Reserve Board put together a bailout group of 17 Wall Street firms to protect the integrity of the markets from these one set of traders who'd gotten it wrong. And they weren't just any traders. The consultants, the designers of the program were Myron Scholes and Robert Merton, who just won a Nobel Prize for how to avoid losses in the market. You can't make this stuff up. It's so good. So these guys were wiped out. They went to zero. They still have their Nobel Prize. And by the way, you're probably asking, okay, so the long-term capital firm and other Wall Street firms got bailed out by the system. Who bailed out the small investor? You guessed it, nobody. Welcome to the game. Another fabulous panic was the China panic of August 2015. China was attempting to alter its financial markets to gear up for a domestic consumption-based economy and not just an export-based economy. But they got it wrong. And the Shanghai market cracked that August. And computers around the world, picking up that crack overnight, began to sell, and in 2 days knocked our stock market down 14%. Once again, computer selling that ran up against itself. And when that happens, markets cease to function. There are just too many sellers and buyers freeze. One of the things that I like about the China panic is that, in a way, these panics aren't just ludicrous computer programs. They do tie into fundamentals around the world. There's no doubt that the Chinese economy is rapidly becoming the largest economy in the world. Its financial markets will, in due course, be the largest financial markets. So when the Shanghai stock market became unstable that August, it wasn't really wrong that affected the world. It was just the mechanics of computer-based trading that made it happen all in a few seconds and made markets unmanageable. So here we are in 2018. We had a mini version of the same. In late January, suppliers to Apple began to report that their orders from Apple were a little weaker than expected, and the market began to worry that the phone and technology sales in the United States might be slowing. Of course, the phone sales ought to slow. The cell phones have gone from $50 to $100, $200, and now $600 to $800. Astounding for a phone. And you ought to get price shock in the system sooner or later. So it wasn't wrong to worry, although the data was pretty weak. But the computer programs, again, a form of portfolio insurance based on current algorithm training, attempted to all sell at the same time in those 2-3 days in late January, early February. And once again, the statistical programs ran into each other, froze the market, and sent the market down 10%. It's a fact of life. And there's an interesting pattern as we wonder what's coming. in the 1970s, I took a look at some of the panic trading that was more human-based than computer-based back then. The collapse of Penn Central and the oil shocks. And I noticed that these panic sales, for some reason, tend to run about 35 days. It seems to take that for the human brain to adjust to the shock of the computer-based trading that's frozen the market and sent it down. And in the past, after that 35 days, the course of markets has diverged. The panic tends to subside, and then normal trading takes over. In 2015, the Federal Reserve Board came in and kept interest rates low and spiked the market back up. The same was true in 1998, plus you had the tremendous opportunities of year 2000. And in both cycles, the market went back up. 1987, the market recovered, but stayed in many ways modest for the next few years. But the bottom of the panic in 1987, that famous Black Monday, was indeed 35 days after the initial sell-off. So here in 2018, our sell-off this year has in a way been conventional. So far, the bottom was around 35 days. It was late March. The degree of our sell-off was very modest. 10% from top to bottom, nothing compared to either 98 or 87. It leaves me a little suspicious that in a sense we haven't seen enough damage to set the market up for more stable trading. The market came a long way under Trump, based on the prospect of drastically lower business taxes. And those are in place, and they are a huge boon for business, but the craziness in Washington continues. Really, the instability of the political system in Washington and the continued discussions of Mr. Trump's future are very disconcerting to a market that, whatever it thinks of Mr. Trump, it really does not want to see his tax cuts revisited. So it's problematic what's going on down there. Plus, it's at a personal level. It's very hard to listen to the daily give and take in our political system. It's not the way any of us are used to speaking and behaving, if I may say so. And I'm regardless of how we view tax policy and foreign policy, I know I can feel comfortable saying that the dislocation in discourse in Washington would reasonably, it seems to me, have an effect on investors when there are other factors that are contributing to investor unease. So it would be nice if 35 days was our low here. We'll see. The 10% decline that we've had from the top of the Trump rally is very, very modest, all things considered, I would say. But we'll see. One of the lessons of past markets is you don't know, and fundamentals change, and how individual trader psychology will adjust to the shock of the computer trading. You don't know. Which reminds me of course, there's J.P. Morgan, who in his day, 1905, that panic, and in the World War I panics, many people thought it was probably true that he effectively controlled stock prices. He attempted to in 1929 and was unable to. There's that famous line of when an admirer asked Mr. Morgan, what was going to happen to the stock market. He looked at them and just said it will fluctuate. And of course, nothing's changed. I put a little note down on the bottom that while it's easy to say nothing's changed, we do have to keep an eye on fundamentals, and the fundamentals here are the very low interest rates we've had for years. So we need to pay attention in this market. I know you know how I feel about that. So I hope that was fun and interesting, and thank you for watching. Bye-bye.